Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 16th of June 2024. And last week we saw precious metals, and in particular gold and silver, rise. Is this the start of a further bullish leg, or is there a period of consolidation due? Well, we're quite positive for 2024, and there are a number of factors that could influence the price this coming week. What are they? Let's take a look. Now first, just a quick reminder, we've set up a second channel entitled Finances Do Matter, covering a whole array of financial topics. We've placed a link in the description box and comment section below for those who have not as yet joined that channel. There hasn't been a video placed on there because we had some problems with our video camera. However, normal service shall resume. Okay, let's look at precious metals. Gold rose $39 last week, rising from $2,294 to $2,333, having hit a high of $2,387 and a low of $2,288, a rise of 1.7%. Interestingly, its high and low were within $1 of the previous week's high and low. Gold spread between the high and low was $99. Now last weekend we said gold would trade between $2,200 and $2,340 as outlier ranges, and it did this comfortably. Admittedly though, it did trade a little stronger than anticipated, the reason for which we shall cover in a few moments. In sterling terms, gold finished the week up £36 at £1,842, and in euros it was up €60, considerable, at €2,186. Now silver rose 41 cents, rising from $29.19 to $29.60, having been as high as $32.11 and as low as $28.70, a rise of 1.4%. The difference between its high and low was a significant $3.41, but there's a reason for this. That said, the rise to $32.11 was in fact momentary and lasted just a minute or so. Apart from that spike, silver traded normally between $28.70 and $30.20. Last week we predicted that silver will trade between $28 and $30.25. In sterling terms, silver closed up 40 pence at £23.38, and in euros it closed up 0.66 euros at 27.72 euros. The gold to silver ratio rose slightly from 78.6 to 1 to 78.8 to 1. Bitcoin is currently standing at $66,241. That's down $3,400. However, as we all know, cryptocurrencies vacillate considerably. Now equities were mixed. The Dow Jones was down 209 points at 38,589. But the S&P 500 was up 85 points at 5,431, and the Nasdaq was up 555 points at 17,688. However, the UK FTSE 100 was down 99 points at 8,146. Unfortunately, oils were higher. Brent crude closed up $3 at 82.62, and WTI crude up $2.92 at $78.45. The dollar index was also up 0.67 points on the week at 105.55, breaking that very important 105 barrier. Now, as mentioned earlier, apart from a momentary spike on Wednesday, gold actually traded within a relatively tight confine of around $51. Now, although we reported last weekend the gold and silver prices were hit by China halting bullion purchases in May and a stronger than expected US labor market, the inflation data announced on Wednesday came out a little better than most economists and traders expected. The CPI figures for May came in at 0%, meaning no rise, and this has had the effect of reducing the year-over-year figure from 3.4 to 3.3%. Markets were expecting this figure to remain at 3.4. The core CPI figures came in at 0.2, compared with expectations of 0.3%, and this meant its year-over-year also declined from 3.6 to 3.4%. Remember, the Fed's ultimate target is 2%. On its face, this is very good news. When one also adds the producer price index fall in May from 0.4 to 0%, this suggests that inflation growth is slowing and may continue to do so. But what cut the euphoria, however, was the Fed's dot plot, which showed a median forecast for just one rate cut in 2024, down from 3 from the March update. Further, there was some concern by analysts about the lack of guidance given by the Fed Chair Jerome Powell after the decision by the FOMC to leave interest rates unchanged. According to Thomas Simons, US economist at Jefferies, Powell deftly avoided being painted into a corner by saying flat out that he wouldn't be specific about a number of months of good data or about specific changes in the labour market data that would start to worry them. Essentially, according to Thomas, the guidance boiled down to, we'll know it when we know it. Once again, though, the dollar index has strengthened, and in spite of that, oil prices have also risen when a small trend of declines were becoming established. We've said from the beginning oil needs to be $10 lower than it is currently before the Fed can seriously contemplate reducing interest rates, and possibly this is why the dot plot is only showing one rate cut for this year. That said, analysts will tend to feel positive and are writing in a September cut nevertheless. But much depends on the data moving forward. We believe a cut too early will halt the progress on inflation, but with a general election in November, there will be increasing political pressure on the Fed to cut rates as soon as possible. In terms of economic data coming out this week, we should look out for Tuesday when the May retail sales figures are announced, jobless claims announced on Thursday, and flash PMIs on Friday. Retail sales are most likely to have the greatest effect next week, with analysts forecasting a rise of 0.2%. Now, an interesting article by Phil Carr on FX Empire concerning precious metals and gold states, quote, "Despite the near-term volatility, traders still remain ultra-bullish on precious metal prices due to an ever-growing number of macro and geopolitical factors that are currently unfolding. These include persistent geopolitical tensions, stickier than expected inflation, growing demand from China as a hedge against economic instability in the world's second largest economy, along with rising concerns over ballooning global debt and uncontrollable government borrowing, which currently sits at a record $307.4 trillion. And last but definitely not least, the de-dollarization movement, which has seen global central bank gold purchases exceed 40 million ounces over the last 7 quarters in a row. That's officially the longest central bank gold buying spree ever in history. Data released last month showed global demand for precious metals has never been stronger. That's quite an achievement given the fact that the Federal Reserve has not cut interest rates so far in 2024 and may only cut rates once this year. In a recent note to clients, analysts at GSC Commodity Intelligence continued to double down on their view that 2024 is the year of the metals, and any substantial pullback should be viewed as buying opportunities because precious metal prices really stay low for long, unquote. Sorry about it being so long, but it was worth mentioning. We tend to agree, and in fact predicted back in 2015, that we would have to wait really until close to the middle of the 2020s before we begin to see precious metals really take off. So where do we believe these prices are heading this week? Well, we're of the opinion that last week's low of 2,288 suggests that gold is unlikely to fall below 2,280 this week. And its momentary rise to 2,387 seriously suggests there is strong resistance at that $2,390 level. Our prediction, therefore, is that we will see gold trade between $2,280 and $24. That's $2,280 and $2,400. And if something out of the ordinary occurs, our outlier range is $2,250 to $2,425. Silver, we expect to trade between $28.50 and $31.50, with $28.25 and $32 as outliers. What do you think? Please share your thoughts. Thank you so much for listening. We'd appreciate it if you would give this video a thumbs up, subscribe, press the bell sign, pop on over to Finances Do Matter. Subscribe there if you haven't done so. Some videos to appear there very shortly. Thank you for listening. Have a great, enjoyable, safe weekend. And as always, a prosperous week ahead.